When you see the credit default swaps on the Treasury market going as high as they are, that's telling you that they're going to have an impasse and a technical default. These are really important times where I think it will be defined by things happening like that. And that's how fast it'll happen. And you know what? Everything that's ever happened in this industry, that's how it happens. Every single time. There is no advanced warning. This is your advanced warning.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for May 16th through May 23rd, 2023, while supplies last. This week we feature the Silver Krugerrand at $3.99 over spot. For years, the Krugerrand was the most known bullion coin in the world, and in 2017, the South African Mint and Rand Refinery began minting a silver counterpart to the famed gold Krugerrand. The Silver Krugerrand bear the Springbok antelope on one side and the portrait of Paul Kruger on the other, and have a face value of 1 rand. They come 25 to a tube, 500 to a monster box, they are IRA eligible and are renowned for recognizability and design. Best of all, they are only $3.99 over spot while supplies last. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest, and we haven't had him as often as we'd like to for the past month because he's been busy on a big book project he's been writing. But Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us this Tuesday, May 16th, 2023. Andy, thanks for coming back on.
Good to be back. And again, thanks for having me. Missed you.
Yeah, I've been out of pocket for, several weeks. A couple weeks I was on vacation, then I was in the hospital and on the mend now. So thanks for everyone's well wishes. Appreciate that. And wanted to check back with you, Andy. First, maybe you could give people a clue what this book project is all about, and then bring us up to date on your latest view of the markets and the macro drivers of our financial world as you keep an eye on all the time.
Yeah, I've become very friendly with Robert Kiyosaki, and he's quite a guy, and he's really added a lot to my life over the last several months in just the discussions that we've had offline, and he's become a good friend. And he, while at dinner one night, thought it would be a good idea for me to take 30 years worth of accumulated knowledge in this industry on top of the things that I've been talking about for the last 3 or 4 years and apply them to writing a book that he would then assist me, shall we say, in doing the things that bring a book to the marketplace. And we're going to be collaborating together, I guess you could say, with his publishing arm of his company. And so it's a real honor, I guess. It's just an honor, but I'll tell you, it's hard. It's not something I'm very adept at. And I write, 5 pages or whatever, and I go back and read them and I make 2,000 changes, but I'm making my way through it. And it's somewhat cathartic to put this stuff down on paper. And hopefully before too long, I have a finished product that I'll actually be able to get out. But needless to say, before I met Robert, I never entertained doing a book. And now that I'm knee deep in it, it's kind of exciting. And it's been certainly keeping me busy, that's for sure. So nothing to report yet in terms of when we expect it to be out. But I'm well on my way to at least 5 chapters into it anyway.
Our family has been well aware of Robert's work for decades. Our teenage kids at the time actually brought the whole Rich Dad, Poor Dad series and the cash flow game and everything into our household. So we got educated up on some of that stuff. And one thing that jumped out to me when you were talking about the difficulties that you're faced with writing, and I think many writers do face difficulties, was something he said in, I believe it was his first book. And he said that a journalist was interviewing him on what makes him think he could be such a great writer. And he said, please look at the cover of the book. It says best-selling author. It doesn't say best writing author. So you don't have to be the best writing author.
Yeah, it's interesting. It's true. And just to give you a perspective, I was at his conference speaking at it a few weeks ago in Arizona, and His book, which came out 25 years ago, is the number one all-time leading best-selling personal finance book. And when we were at the conference a few weeks ago, they pulled up the current Amazon category for, personal finance. It was number 2. 25 years later, it's a timeless book. It's really fantastic. And I'll tell you, the cash flow game was something that I didn't know what to expect. And they played it. Everyone played it one day at the conference. I really didn't know we were going to play a game. It was fascinating. I learned a ton. You learn how to read a balance sheet. What is important on a balance sheet? You learn the importance of cash flow. You learn the importance of balancing your balance statement to making it your cash statement. You learn how to balance assets versus liabilities and the importance of cash flow. These are things that should be taught to everyone in high school because it's so vital. Here I am running a precious metals company that's done over $8 billion in sales, and I learned quite a bit in 2 hours of playing that game about the balance sheet and about properly classifying everything and ways to strengthen the balance sheet and maybe not great decisions to make that work against the balance sheet. Anyways, I highly recommend it for everyone, and especially for younger folks who are learning, just learning the way their way through this world. And there's a lot to be said for understanding a balance sheet more than I ever would have really admitted to before I played that game. So it's something that I was very surprised by.
Well, we'll keep our eyes out and our ears open for news of your book's timeline so that we can keep an eye out for that. And meanwhile, you continue to do ongoing research on a daily and weekly basis into what is moving the markets, what's shifting the balance of power as far as monetary standards around the world. Can you bring us up to date, since it's been a while since we've gotten your latest thoughts in that area? And a lot of our viewers are keenly listening and watching for your perceptions there.
Yeah, look, there's so much going on. I focused so much over the last several years, as you know, on the BRICS nations and this growing chorus of countries moving together and watching Saudi Arabia and the alliances that they are making. And while that's very, very important, there's also a lot of stuff going on here, as people understand. And a couple of things that are worth mentioning, and I may have spoken with Elijah about this last week, but I think it's worth mentioning again for those people who didn't catch this, a couple of things. Number one, there's a man named Jared Bernstein, and Jared Bernstein wrote an op-ed report in the New York Times in 2014. Yes, it was a long time ago, but the report was called King Dollar No More, in which he advocates for the United States really moving to and actively moving to remove the U.S. dollar as the world reserve currency. And he cites all sorts of reasons surrounding trade deficits and financial bubbles and all of this stuff supporting his theory. But okay, so what does it have to do with anything? President Biden just nominated him to be his top economic advisor. This is a guy who advocates losing or getting rid of the world reserve currency. Now, does that mean anything? Don't know. I just think it's very interesting. Just as interesting as Lael Brainerd going from the Treasury to the Fed and then now running an economic advisory committee at the White House as well. And her whole thesis when she was running for the Federal Reserve is to get rid of all of the banks, the commercial banks included. And well, what better way to get rid of all of the banks than to light a fuse under the regional banks? And they've done that. Certainly, we've talked at length. Everyone's talked about the admission by Secretary Yellen, who told the representative from Oklahoma that banks in his state probably wouldn't be bailed out, these regional banks, if they failed, unless there was an uber majority decision from the FOMC, which is the Federal Reserve, the FDIC herself, and the president as to the systemic nature of these banks. And she said, no, probably won't be bailed out. And that lit the fuse. But what is very interesting is the aiding and abetting of this exodus from the regional banks by the Federal Reserve, who continues to allow funds from the money markets to go into the overnight reverse repo market, paying over 5%. So you can take your money out of a regional bank that we are being told by Janet Yellen will not most likely be bailed out if it fails. There are rumors that, and they've talked about it before, that if there is a massive run on the banks, not a walk, but a run on the banks, that the Fed would backstop as much as only 10 cents on the dollar. Because before I finish my thoughts on the regional banks, FDIC at the end of 2022 only had 128 billion in assets. They just were lent 174 billion by the Fed. The Fed lent FDIC 174 billion. Do anyone see a problem here? There's $9 trillion in deposits, excluding those from the commercial banks. So the backing of FDIC is nothing more than nothing, really. It amounts to absolutely nothing, to the point where they need to borrow 174 billion from the Fed. And so when you talk about the exodus from the regional banks, not only have we been told they most likely won't be bailed out, but the best you can do in a regional bank right now is a CD for 1 year earning roughly 5%. You're locked in for 1 year in a bank that if they fail, you're bailed in. Versus moving your money to one of the too big to fail banks, as we've been told that they would be backstopped, where you can get daily liquidity in a money market fund backed by the Federal Reserve in the reverse repo market, earning 5%. There is no reason for anyone to stay in these regional banks. And when you realize that these regional banks comprise 70% of all the small business loans, close to that amount, 70%, in all the commercial real estate leases and loans that are all going to reset, with rising interest rates and difficulty on the small business and on the commercial real estate owner, you're looking at almost a mathematical certainty that we will continue to see problems with the regional banks. And then you go to the raising the debt ceiling. It was a real big problem for me the last time Janet Yellen said, well, we need to take extraordinary measures to raise the debt ceiling. All along, they're funding the Ukraine in this war, giving them over $130 billion. But we have to take extraordinary measures to raise the debt ceiling. Well, what were those extraordinary measures? She doesn't talk about that a lot, but she borrowed money from the Civil Servants Retirement Fund, the Postal Service Retirement Fund, and the Disabled Veterans Retirement Fund. Now, I don't know that she paid it back any more than the 2022 balance sheet of the U.S. government shows a $76 trillion shortfall, because money was borrowed from Social Security in Social Security, and Reuters is telling us it'll be bankrupt in 10 years or less. So things are happening at breakneck speed, but it's baffling to me why the Federal Reserve is allowing the money markets to pile into the reverse repo market when all that is doing is accentuating and aiding and abetting this regional bank problem. And as far as I'm concerned, take a step back, and it becomes almost as if this is what they're trying to do. Now, I'm not saying that's what they're trying to do, but if they wanted it to stop, all they would have to do is say, sorry, the money markets are no longer allowed to put their money in the overnight reverse repo market. And that would quiet things down a bit. But look, it's not even that. You're seeing the major banks lose billions and billions of dollars. This is a banking crisis, not just regional. Even the big banks, they're losing so much in the way of deposits as everyone is chasing yield and chasing treasuries, which brings me to my last point, and then I'll shut up and listen to your questions. And that is the 1 month treasury. The yield on the 1 month treasury right now is almost 6%. Why? Because that coincides, if you look at the last treasury auction, with almost to the day that the debt ceiling will have to be resolved. Now, are they going to resolve it? Well, at 6% interest on the 1 month treasury, it looks like no. If you look at the credit default swaps on the treasury market, they've gone through the roof. The most sophisticated traders in the world are all but telling you, they're guaranteeing a technical default. They're saying we're going to default. Now, what does that mean? Well, they still have the printing press. They're not going to default on paying the military and doing these things that need to be done, but they're going to have an impasse. They're not going to let the government open if you legitimize the reverse, or if you legitimize the credit default swap market, which is saying this is going to happen. Sorry, I'm battling some allergies down here. And I think it will happen. And when Janet Yellen said, if this does happen, look for dozens of regional banks to fail like that. Now, I mean, look, there's enough going on around us, whether it be here or everything we've talked about for 3 years with the BRICS and this growing unison of countries, including even France, who is distancing themselves from the West in the way that we are talking about backstopping Taiwan, in the way that we are talking about sanctions, and all of the things that France stood alongside of us for. They are now distancing themselves and have signed a 51-point agreement with China ranging from 5G to military engagement. We are beginning to be isolated and watching countries like Mexico and France and Saudi Arabia and Turkey that have traditionally been our allies start to move in the other direction. So whether you look outside the country or inside the country, done again, things are really starting to accelerate.
We often like to then bring that from that macro picture that sets the backdrop and sets the stage for the fundamentals that are driving people's behavior of trying to protect themselves, trying to take prudent actions to protect their families. We like to bring it down and talk about what you're seeing in the retail precious metals markets, both in terms of sales volume, premium trends, availability as you look out, because a lot of people, I've noticed, there was a huge burst of activity, back about a month or two ago, and then it seems like now I see the drumbeat of people who have made their decision to make strategic moves, whether it's IRAs or taking major amounts of funds out of the bank from having sold a home or a property or whatever. They just aren't wanting to keep those large funds in the bank anymore. What are you seeing across the board on the retail precious metals front in terms of both supply, demand, and premium trends?
Let's start with the a step above that. That would be the COMEX and the London Metals Exchange. And, on COMEX as an example, just the first 4 days of May deliveries saw 1,744 gold contracts delivered, taken off. Multiply that times 100 ounces, it's 1.744 million ounces of gold taken off in just the first 4 days. And it was quiet. The silver deliveries in what is typically a very big month for deliveries, very quiet on COMEX, but that is done for misdirection, because if you look at what's called the exchange for physical, those are contracts written on COMEX sent to the London Metals Exchange and exchanged for physical. Last month, 112 million ounces were taken off of the London Metals Exchange. This month, 118 million. You're talking 230 million ounces were delivered off of the London Metals Exchange in what's called exchange for physical. This comes at a time when, for the first time since 2017, and maybe only the third time ever, the registered category, that is the category backing all the contracts on COMEX, is below 30 million ounces at 29 million ounces. So in 2 months, we saw literally 10 times the amount of silver that is backing COMEX delivered off the LBMA. And when you look at India last year importing 304 million, we're getting to the point where the big money who has been trying to quietly, methodically de-dollarize using metals and the Western suppression to run cover for it, they're running out of ammunition. And one of the things that I find most interesting is that premiums right now and availability's gotten better and premiums have come down. Now, it was complete and total chaos for 3 weeks after Silicon Valley Bank. And then all of a sudden, once again, people's memories are so short. Everything's okay. Everything was bailed out and taken care of. We're back to business as usual. And things have slowed down. And I'm very surprised by it. But when I see what's happening 2 steps above, it's only a matter of time, because the most sophisticated investor on the planet, who's closest to the information and to the wallet, is showing us that they are rapidly and with continued vengeance, pulling metal off of the big exchanges, which will lead to a trickle-down effect, if you will, to the retail market. Something is going to happen that's going to jar people's memories again. And while it's still busy and considerably busy, I'm shocked that the premiums have come down a little bit since last month when things were insane, and the availability is really quite good right now. What does that really mean? It means that it's good for now, but if you see a greater expansion into the mainstream, we've talked about this before, where the really big money who just realizes that, wow, this is for real and I need to do something, I need to bypass my money manager and take initiative myself. When that really big money looks to gold and silver the way that the people watching this show have for a long time, what is plentiful and fair premium real quickly becomes not in both categories. So I think it's a great time right now in terms of price, in terms of availability, in terms of premium, especially measured against the backdrop domestically and internationally of all of the things stacking up against the dollar. Then again, I quite frankly can't see a better time to ever add to your stack right now, because the premiums are the best they've been really in the last 45 days or so.
Yep, we've seen a lot of people making their moves, and you're right. It is a battle against human psychology, because the same trends, when they reveal themselves in a macro sense that get people concerned, then when there's a little pullback, a little breather or whatever, rather than jumping on that opportunity, some people naturally, out of human nature, think, oh, well, maybe we're back to normal. Normalcy bias will just take over again. And I have numerous clients who are temporarily successful at reaching family members and friends who are starting to say, what's that you've been talking about for years, when they were like the black sheep of the family or that sort of thing, or the strange voice at the water cooler that nobody else understood what they were talking about. Now in the last couple of months, they've actually been getting some connection, some traction with people. And we've been helping a lot of referrals because of that.
Yeah, that's exactly right. And not only that, people who have invested in gold and silver long enough understand the disappointment and the counterintuitive nature of price in this market, where it just doesn't make sense. Well, take a step back. If you are trying to misdirect the public, the best way to do it is through price and through rhetoric, and they've become very adept at doing that. So none of this surprises me, and that's why so few people are invested in it. As we've talked about forever, 0.5% allocation in the entire financial matrix of the United States. Well, okay, that's because of the rhetoric and because of the volatility and the counterintuitive price action. But by the same token, even those people who own it, they've either learned to deal with it, or they're just they know that their conviction ultimately mathematically plays out. I look at this, and mathematically, I see no way that gold and silver don't really, really get expensive at some point. I mean, look, take the bricks out of it. How the hell do you pay for Medicare, Medicaid, Social Security, and government military pensions which are off the balance sheet and account for $130+ trillion, plus a $31 trillion debt? When Social Security tells us that they'll be bankrupt in a decade, they already are, with $76 trillion in IOUs in it. When you look at the largest asset in this country being student debt, according to the 2022 balance sheet, we're an insolvent country. And in order to pay for all of these obligations, let alone the ones that are funded, the unfunded obligations, the Medicare, the Medicaid, the pensions, how do you do it? And the only way you will do it is either it'll be by inflation, or if you try and, tighten up the balance sheet. If you really try austerity, try to get your balance sheet in order, you blow up the whole system. So it's either inflate or default, inflate or die. And I think ultimately people need to understand that looking at these short-term gyrations isn't the way to win this game. It's to see the forest for the trees. Don't get blindsided by the rustling leaves. Take a step back and say to yourself, how the hell does this ever work out? Why do you think the central banks are buying more gold than at any time ever? Why are all these countries moving away from the Western hegemony? Because it's not just the sanctions, it's the mismanagement of the currency and the fact that they see that they, hey, do you want to sell your oil or your party favors for a dollar that ultimately will depreciate in value through inflation, or for treasuries that are getting absolutely killed the way that they're affecting the regional banks and all the banks for that matter, who are loaded up on treasuries with 2 and 3% coupons? And I think ultimately the math is on our side, and this is one of those sweet spots where if you don't realize it, you're ultimately destined at some point to realize it and pay a lot more money for it if it's even available.
You mentioned there that we have a lull here in the burgeoning premiums that had been characterizing a lot of the last year or more. And can you give us an example in the form of a weekly special that people can take advantage of if they want to right now?
Yeah, 2023 Silver Krugerrand's at $3.99 over the price of silver. That's a special, believe it or not. And you look at Silver Eagles at like $16 over the price of silver. Krugerrand's at $3.99 is a pretty darn good price. They've averaged north of $4 and $5 an ounce for the better part of 3 years. So they are in stock, and if you're looking to add some sovereign coins to your portfolio, it's a good idea because, look, a lot of these states are passing laws, and this is part of the reason where we're seeing, I think, ultimately increased awareness is these states are passing laws. The majority of the laws that are being passed in 8 or 9 states that are accepting gold and silver as legal tender says any sovereign issued coin. Now, a few of them, I think Texas and a few others, say only American-made coins, furthering, I think, the demand for gold eagles and gold buffaloes and fractional gold eagles. It's just so hard for me to recommend silver eagles in this environment. But a lot of the states say any coins issued by a sovereign government would be accepted as legal tender via their melt weight plus market premium. So look, a Krugerrand, a Maple Leaf, a Philharmonic, a Britannia, a Kangaroo, any of these coins on top of an eagle will ultimately, it appears, is becoming legal tender in this country. And many of the states are moving in that direction. And I think you'll see many more of the red states follow suit as a way to allow their constituents, escape valve from what the Federal Reserve is doing to the value of the dollar, what the Treasury is doing to the value of the dollar. And it's disgraceful. And, can you imagine Elon Musk standing on stage saying the goal of Tesla is to lose 2% every year? We're not even anywhere near 2%. I looked at Shadow Stats last night. His measure of inflation is still over 8%. So, we're a long ways away from really tackling inflation. And they're going to have to keep rates elevated for a very long time to come anywhere near their 2% goal of inflation. And so inflation is here to stay. And even if we see the money supply, the M2 money supply cratering and banks tightening their lending standards, which are both very deflationary, well, that's going to lead to, the whole system blowing up. None of that explains how do we pay for all of our liabilities, both funded and off balance sheet. That has to be addressed at some point. How do you do it? Well, at this point, it looks like they're telegraphing that they're just going to print more. That's what they do. That's the only thing they know how to do. And look, when you see the credit default swaps on the Treasury market going as high as they are, and 6%, this massive divergence between 1 and 3 month Treasury of almost 2.5% or more, that's telling you that they're going to have an impasse and a technical default. How long does it last? What are the ramifications? How many regional banks fail? Because, look, for Janet Yellen to come out and say dozens will fail if this happens, is she bluffing or not? These are really important times where I think it will be defined by things happening like that on a Sunday night, Monday morning. I knew I should have done that. What was I thinking? Why was I waiting? And that's how fast it'll happen. And you know what? Everything that's ever happened in this industry, that's how it happens. Every single time. There is no advanced warning. This is your advanced warning. And I'll tell you, it is my firm belief, especially looking at the massive drawdowns continuing day by day off of COMEX and the LBMA, This is for real. And the most sophisticated, well-funded, well-informed investors on the planet are telegraphing that. So either take a leap of faith, trust your gut, get out of harm's way, or in my opinion, ultimately end up being a victim. And when you read that, look, even the big commercial banks, which are watching lots of money leave in search of yield in treasuries, when you read that they've talked about if these banks fail, the too big to fail banks fail, they'll be compensated at 10 cents on the dollar. Well, look, FDIC is bankrupt. They have $128 billion. They borrowed $174 billion to allow the banks that have already been bailed out a smooth transition while others take over. But if they only have $128 billion and are borrowing $174 billion, what does that say for the $9 trillion in deposits in the regional banks, or the $18 trillion in the entire U.S. banking system? It's a Ponzi scheme. It's a shell game. And the only way that anything is ever bailed out is by creating more money and creating more inflation. It's the old playbook. That's all they got at this point. And I don't know. I think this is as real as anything we've ever talked about in all the years I've been with you, Dunnigan.
We're certainly grateful for that, and glad that we were able to get you back on again after the 3-week hiatus, and glad to be back with you personally, myself, and with all of our viewers whom we appreciate so much. That you out there, all you who are watching this and subscribing and sharing these with friends and family, are the ones who keep this going. And it's all about trying to reach as many families as we can, help as many people as we can to protect their family's future. And Andy, you're a big, big part of that here, and we're grateful for your presence always here on Liberty and Finance.
You know, I love you, Dunnigan. I just want to say one more thing, because this one I haven't heard a lot of people talk about. There's a lady named Kristalina Georgieva. I don't know if you've talked about her or not recently. She is the head of the IMF. And I just want to read something. Meanwhile, Kristalina Georgieva, head of the IMF, blamed complacency for the U.S. bank failures. We know there was an unnecessary deregulation, and now we saw the price to pay. We saw supervision has not been up to par, so we need more regulation. She says, Georgieva also warned that the rapid pace of the recent U.S. bank runs, which were fueled by savers' ability to move money online with a single click, would require a lot of new regulatory thinking about how we deal with this. It's the speed that money can move from one place to another. It goes into the territory of the unthinkable, she added. That means the head of the IMF wants to limit the ability for you to take your money out of the bank if she has her choice. And so all of these things require being proactive, not reactive. And I think when you see the head of the IMF say these kinds of things, they should not be taken lightly. Ultimately, I think it will be a system that will have more regulation, an inability to move your money freely, and the choices for where you put it are becoming harder and harder to find with any value or any ability to get them at a good price within a reasonable time frame. I'm talking about precious metals right now. And so keep all of this in mind as we head towards, the beginning of June with the debt ceiling problem and what that really means on a bigger picture. So anyways, Dunnigan, I'm glad to be back. I'm glad that you're back, and I look forward to picking up where we left off on a regular basis next week, Tuesday as well.
Sounds great, Andy. Thanks for coming on.
All the best.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.